how the wealthy invest, and what we can learn from them. First of all, what is considered wealthy or high net worth? How does one become wealthy or acquire a high net worth? What is the typical investment allocation of those with a high net worth? Are there investments that only those with a high net worth can access? What professionals do wealthy people use and how? What are the personal habits of those who acquire a high net worth? What type of charitable giving is done by those with wealth? And finally, once you've acquired wealth or your high net worth, how do you keep it? We'll answer all these questions and more on this episode of Through the Pines. All right, welcome to a financial planning podcast with a down-to-earth vibe. Sasquatch listens while reviewing his own portfolio. This is Through the Pines. Our financial planners are planwithbaxter.com. We have Rex Baxter. It's named after you. So planwithbaxter.com. And Brandon Smith, Brandon with the Y, not to be confused with my own R. Brandon Long. Brandon, who needs more books on his desk behind him. But the desk looks nice. I like the plant, actually. I really like the plant. That is very nice. You. Yeah. We are going to be discussing on this episode how the wealthy invest and what can we learn from them. If you have not liked our Facebook page, please do so now at Through the Pines. Follow us on Instagram at Pines_podcast. And if you're not watching this on YouTube live right now, subscribe to our YouTube channel. You can catch the replays or just it'll be up there for life. So it is Through the Pines podcast on YouTube. So let's begin by defining what is wealthy, what is ultra wealthy or high net worth. And I made the joke before we started, I'm closer than I thought. I'm only $1 million away and not 10 million away. So I don't know what is 1 million still high net worth, Rex?
That is still the popular definition of high net worth is $1 million in net worth. So let's just define net worth really quick, right? You take everything you own, you subtract out anything that you owe, and that is your net worth.
That's right? A high net worth, 1 million. Okay.
Yep. And so ultra high net worth is typically considered 30 million or more.
Okay.
Is typically considered ultra high net worth.
Ultra.
What a fun topic. I'm excited for today. This is going to be good.
I like to call them my DECA friends. So my DECA friends, they've got they're 10 million plus $1 million in the bank. If they do, they haven't told me. I don't know who they are, but those are my DECA friends there.
Can we change it to tri-DECA?
Wow.
Or something.
Yeah, well, that would be a lot when it's 30 million in the bank. That's good. Those are good people to know. If that's your friend group, that's a good friend group because, they say your income is what is it? Your income is the average of like the closest 5 people you hang out with or something like that.
If that's your friend group, don't hesitate to hit us up. We're on LinkedIn, Facebook Live, planwithbaxter.com.
Okay, wait.
If that's your friend group, we want to be friends.
Yeah, we'll just go ahead, learn more, visit planwithbaxter.com. Well, very good. Okay, so that is the net worth. Okay, but how did they get there? How do these people create this money, Rex? Well,
so most of them, to get to the high net worth of $1 million, a lot of people are there. And so between equity in their home, 401k plans, savings, investments, possibly rental properties, there's more high net worth right now in America than there ever has been in history.
Okay.
And so a lot of people are in that high net worth category. In order to move from high net worth to ultra high net worth, typically something significant has had to happen in your life normally. And so either you started a business that has been extremely successful, you inherited some money and was able to leverage that into additional investments or rental properties, something along those lines, or you started really young and have done a fantastic job of doing the basics, living on less than what you earn, maximizing your tax strategies, using professionals to be in real estate or starting businesses or financial assets, things like that, and have been willing to take significant risks and have and have gotten those risks correctly a lot of the time in order to get to that ultra high net worth. But typically, you've had to have something fairly life go right to get to that ultra high net worth level.
Okay, well, I would assume that if you have that much money, if you are ultra high net worth, that you understand money. But how many times in your practice have you met with people that are wealthy, high net worth, and they really need your help because maybe they're not invested correctly or something?
Frequently, right? I mean, you think about the world today and different ways that you can get to the ultra high net worth. And so think about, a farmer, right, that may have a couple thousand acres of farmland or ranch land. And now all of a sudden, they're ready to be done farming or ranching, and the kids aren't overly interested in taking it over. And so he sells that to a developer. And now all of a sudden he sells that for, 20, 30, 40, 50 million dollars. And he has significant wealth, but he's never had money or significant liquid wealth in his life. And so it's gone from an illiquid asset, which he's had his entire life and he knows how to manage extremely well, to a liquid asset that doesn't have any real experience with liquid financial assets. And so, frequently we run into situations like that, or they've ran a business and all of a sudden now they've sold their business and they're great at running their widget business or sign business or whatever that is. But then when we all of a sudden move it into the financial markets, that is a realm that's completely out of their expertise. Mm-hmm. And I think one of the things that the ultra high net worth are that remain in that category are very good at is utilizing professionals, finding competent and trustworthy professionals that they can lean on to fill their knowledge gaps.
I think one of the least recommended strategies is to rely on the lottery to become. But I saw this video on YouTube yesterday, and it was like the dumbest lottery winners of all time. But it broke down like lottery winners who lost their full amount of money, their winnings, in like the fastest amount of time, because they have no idea what to do with the money, which is wild.
Yeah.
Coming into it. Okay, Brandon, you wrote down some notes on, how to become wealthy. And I mean, before we're ultra wealthy, let's bring it back a little bit and become wealthy, which is $1 million in net worth. Some of the notes you have on here is live on less than you earn, maximize tax strategies. You want to expand on these?
Yeah, I would say that becoming wealthy and having a respectable, good retirement is actually a lot, it takes some discipline, but it's a lot more process oriented than a lot of people think, right? I mean, it's amazing when you sit down and you say, wow, if we just save 10% of our income from age 25 on, I mean, you're there, right? Like, it's just that simple. As far as maximizing tax strategies, there's several very simple things available. Roth IRAs, if you're eligible, traditional IRAs, 401ks. And we're able, and there's a lot of different caveats and what you're eligible for, but no matter what, we can find something. We can figure out how to utilize at least one of those depending on income. And it's almost crazy not to, right? I mean, these are just very simple things. In fact, we've got a lot of clients who do really, really well with their businesses, and they come to us and they say, hey, look, if life continues to go as it's going, I'm going to have more money than I'll ever need, right? Because I'm growing this business and the outlook is so bright. However, I understand that one, shift in business or one change in law or, one of anything, because it's all of the future so concentrated in that one venture, could derail that. And I don't ever want to find myself in a spot where I can't retire, And so although they've got this amazing thing going for them, they'll come to us and say, hey, I want to take some out and diversify it. I want to make sure that no matter what, I'm still able to eat. I'm still able to go on vacation. I'm still able to live the life that I love. But, how do we do that? And so I'd say that kind of fits into this, right? Let's make sure we're saving, a good percentage of our income. Let's make sure we're diversified. Let's make sure that our investments are set aside so that we've got enough in equity markets so that it can outpace inflation, so that it can grow for us for the future. And then let's make sure we fill in any blatant gaps, right? You've got insurance gaps. Like, if I were to pass away, although my family's on a great trajectory, if I pass away, like we're sunk, right? Because it was all dependent on me being able to make an income down the road. And if that's not there, we need life insurance to take care of that. We need disability insurance, right? To make sure that if I am no longer able to work, that we can still eat. We need home and auto insurance. If someone gets in an accident, I don't want that to derail my entire emergency fund because we have to go buy a new car. And so making sure that those basic pieces are in place are so important, really, no matter what your plan is. With that said, doing those things, that's never going to make you $30 million, right? Unless your income's crazy and you're saving 10% of a really big income. You're not likely going to go into this ultra high net worth. But I would view, the basics as almost like the backup plan to make sure that, no matter what happens, it allows you to take the risks you need to really shoot for the bigger numbers. So,
Rex, is this something anyone can do? In other words, if you're not born from wealth, you don't have wealthy parents, you don't know people, do you think, well, that's not who I am, it's not what I was meant to be? Or are there healthy habits, lifestyle changes that you can make, sort of like, fitness and being fit, that you can just implement into your life to become wealthy? I pulled up an article it's 2021 article from lifeandmyfinances.com, and they listed some common practices of the rich. And if you could just give me your feedback on this. They're frugal savers, take on side hustles or start their own businesses, which you mentioned, studiers and planners of their investments, not just mindlessly putting money into a 401k, more prone to personal growth, reading and studying. They work hard, think more, take time to think about how they can grow their money and wealth. Interested in feedback and don't get offended when people talk to them about money and what they should be doing with it, and beginning with the end in mind. Those are just some of probably a lot of different habits or traits that we could find in wealthy people. What are your thoughts?
I think that articles like that are a little bit generic in nature. And I think a lot of those will get you to the high net worth and somewhere in between, that 1 to 5 million. But to really get to 30 million and above, it's going to be more than that, right? And can you get there? Absolutely. It's the American dream, right? And so you can absolutely get there. You just need to not be afraid to fail, learn from your failures quickly, and then make sure that again, that you're taking those calculated risks as you try and get there. And even then, not everybody's going to get there, but some of you will. And so it's a matter of a mindset. I do think that there are some common traits on people that get there with financial or business assets, to where they are critical thinkers. They are reading a lot of books and not wasting time, watching, a lot of TV or playing, computer games or different things like that, to where they're maximizing the efficiency of their time. But I do think that that's not all of it, right? Those are components. But I think if you're to gather 10 or 20 of the ultra high net worth into a room, that my guess is that they have extremely different hobbies, traits, paths to get there, as varied as you and I are.
Yeah.
So.
Well, speaking of the high net worth individuals, what do their investment portfolios look like? And is that something that we can learn from who we haven't got there yet? So should we invest similarly to them, like that they're a good example, or do they invest completely different than most people?
Well, completely different is a big word, but I would say that they do have additional opportunities that the high net worth and those areas don't have. And so, when we look at investments, we typically break it down into kind of 4 different categories, sometimes 5 categories, but you have stocks or equities, you have bonds or fixed income, you have cash or cash alternatives, and you have alternative investments, which some people will throw real estate into alternatives. Some people will have real estate as a fifth category. And I think everybody in general should have kind of those mixtures in their investment portfolio. Whether you're high net worth, whether you're striving to get to the high net worth, whether you're high net worth striving to get to the ultra high net worth. I think the difference is that the ultra high net worth have additional opportunities typically in each of those categories. And so when you look at equities or stocks, most of us use public equities or public companies, companies that trade on the New York Stock Exchange or trade on the NASDAQ or over the counter. So all these public companies, whether it be, Walmart, Amazon, Apple, Home Depot, right, whomever. And that's what the majority of us can invest in. Well, when you start to get past the high net worth and kind of striving financially for the ultra high net worth, then you can get into private equity, right? So then you're buying interest in companies that aren't public yet. And there's hedge funds that do this. There's private equity firms. There's venture capital. There's angel investing. There's a lot of different avenues to play in the private markets of the equity markets.
Rex, do you do any of that personally on the side, or do you keep everything public, or can you as a planner? I don't know how that works.
We can. You're allowed to do. And so we have access to private offerings. We have access to alternative offerings, hedge funds, right? We have access to all of those tools as far as ourselves and working with our clients. However, again, there are minimums, right? The Securities Exchange Commission, the SEC, has set certain criteria because of the complexities and the illiquidity of some of those investments as to who can invest in different things. And so, some of those titles would be an accredited investor. And that's where you have $1 million net worth, excluding your home, excluding your primary residence. Right. So we don't get to count the equity in the house anymore. Now it's rental properties, it's financial assets, your 401k, it's, business interests, things like that. But you have to have over $1 million net worth, excluding the home, or you have to have, $300,000 of income if you're married, filing jointly, for at least the last 2 years in order to be an accredited investor. And that opens the first door for some of these other offerings.
Now, do you manage those, Rex, the accredited investment accounts?
We do. And so we don't, so we'll work with a third party, right? Okay. So we don't go out and select the private company that's going to go into that private equity holding. We'll work with a private equity manager or a private equity offering or a private real estate offering or a managed futures fund or a merger and acquisition fund, or, there's any number of these different hedge funds that are out there. And we'll work with those companies and their offerings to offer to the clients. Right.
Just a clarification. That was merger and acquisition, not murder and acquisition. I don't know if there's a computer glitch. Just want to make sure. This is all on the up and up.
Yeah.
I've been watching a lot of crime scene movies lately.
Murder and acquisition never ends well. So for everybody involved.
I mean, you might get the business for less, but it's not worth.
It's not going to end well. That's for sure. Yeah. All right. Okay. So that was the accredited investor. $1 million net worth, excluding your home, or 300,000 plus, married, filing jointly, at least 2 years of that, and then there's more alternative investments, Rex.
Yeah. So just to clarify on the accredited investor, it's 300,000 if you're married, filing jointly for at least the last 2 years, and expected to be that or above for the next year. And if you're single, then it's 200,000 of income for at least the last 2 years and expected to be that. So the next level is what they termed, and they made this change a number of years ago, but they now term it a qualified purchaser is the next level up. And in order to be a qualified purchaser of investments, you have to have a $5 million net worth, excluding your primary residence, or $25 million for an entity. If it's a business or an LLC or something like that we're trying to purchase different things. And so, if you're a qualified purchaser, then again, additional levels of of investment opportunities open up to you at that point.
Okay.
So,
exchange funds, hedge funds, managed futures funds. I've never heard that one, I don't think. Maybe I should have. Private equity offerings and real estate private placement funds. Where's that portfolio, Rex? How do I get into that one?
So all of those are in that alternative category.
Okay.
Right. And so typically when you're dealing with high net worth or ultra high net worth, we're dealing with asset allocation, right? And so you might still say if you're an aggressive investor, you might have 80% in equities, whether it be private or public. You may have 20% or 15 in fixed income, a little bit in cash, and another 5 to 7 or 10% in alternatives. And so it's that when we're talking about private equity offerings, hedge fund offerings, real estate private placements, things like that, then typically you're talking that 5 to 7 to 10% of your portfolio. When we get into ultra high net worth, sometimes we'll let that alternatives creep up a little bit higher, up to maybe 20% or 25%, because we have other significant liquid assets to where we don't mind having a little bit more tied up. A lot of these investments are 5-year, 7-year, 10-year, 15-year investment periods, time horizons on some of these investments. And so you're illiquid for significant amounts of time when you're going into these. And so we need to have significant net worth in order to make sure that we don't run into a liquidity issue on your personal finances.
Well, every investor is different, and every high income or high net worth investor is different. I saw an article that listed their cash holdings anywhere from like 5% to 20%. Does that ring about right with you?
20% seems awfully high for most of the ultra high net worth that I see, unless they're stockpiling cash for a project, right? For a major real estate development, for a private equity offering, for something, or a liquidity event, a business that they're trying to buy. That seems extremely high. A lot of times I'll see it somewhere in the 2 to 10%, depending upon what's going on and their risk tolerance. But when you think about cash, I mean, cash is, although it may be king, it sure doesn't pay well, right? Yeah. Typically. And so, they like to maximize their dollars and make sure that they're working as efficiently as possible. And so lots of times we'll even be, if we're at that 2 to 5% on cash, we may be utilizing a lot of leverage and leveraging their stock portfolio or leveraging some of their real estate assets or business assets at fairly attractive interest rates in order to maximize those dollars to take advantage of other investment opportunities that they have. And so that's one thing that we do see with the ultra high net worth is that they're open to the idea for the right situation to utilize debt or leverage in order to maximize their net worth growth and the opportunities that are open to them.
All right. What about some of these other investment things, vehicles that maybe we don't always consider? One we do consider precious metals. Do you see a lot of high net worth investors in precious metals?
I don't see a lot of that. I see a little piece in that. Most of the ultra high net worth aren't. I mean, lots of times people go into precious metals because they have kind of a doomsday look on the world and the economy, right? That if the government ends, we go into some catastrophic event, then I want precious metals for a bartering system.
Yeah. I've got my doubloons.
Right. And so, I got my Baxter bullion over here, right? Going on. And so, that's where, so sometimes we'll see a small weighting, just because sometimes you'll see precious metals that do a little bit better from an investment standpoint during weaker economic cycles. And so sometimes you'll see a little bit of a weighting in portfolios, but generally you don't see an enormous weighting in any of those kind of fringe, or what I would call kind of fringe investment alternatives, whether that be precious metals, collectibles, fine art, Pokemon cards. No, I'm just kidding. But
Yeah.
you know what I mean, right?
Yeah. Well,
as far as those
fine,
kinds of
fine
things.
art sounds fun. Collectibles they'll sound more fun. Like, and that's all personal. Like, so who's the guy that just?
I don't know, but Jay Leno with his cars.
That's what I was
right?
thinking of. Jay Leno with his cars. That's a collection. Well, he did it right. Yeah.
Right.
Yeah.
And it's a significant collection, and it's an appreciating collection, which vehicles typically aren't. But when you get into fine collectibles, then they're appreciating, and it's interesting. I saw a chart. Gosh, it had to have been at least a decade ago, of the average rate of return on collectibles, fine arts, precious metals, and it kind of had all these other non-traditional investments kind of listed out on rates of return.
Mm-hmm.
And over long periods of time, they tend to be similar to kind of equity rates of return. But they certainly have very volatile cycles in between those long period rates of return.
Yeah.
So,
and that's the key to all portfolio building, whether it's ultra high net worth, whether it's high net worth, wherever you're at. It's understanding future needs, future liquidity needs, and cash flow, and when do I need this money? What money do I need to be able to count on, and how much of each, right? Whether it's the more complex products or even simple products, we need to know, if you put money in the S&P 500 or any type of equity style market, if you put money in there, you're going to have to accept that there's going to be market risk, right? It's going to move up and down. And if you do that, like there's time frames that you need to be willing to accept. For example, you can't put money in the market knowing that you're going to need it in 12 months, right? That's a bad idea, just because you never know when the market's going to come down, and you're going to need to wait 3 to 5 years before it comes back up. And that's also true of real estate, right? You can't go out and buy a house and think that you can just unwind that transaction no matter what in a year, because sometimes you can't. Sometimes interest rates move, sometimes markets move. And so really that's where the planning comes in, no matter where you're at in this life, is how do we structure investments such that they're diversified, so that we can move through a variety of potential scenarios, so that we see growth, and so that we can also make sure that we're always going to have enough to sell out of. I've seen plenty of times where people have a crazy high net worth, and it's all in real estate. It's all in farmland usually, or some type of real estate, and they can't get it. They don't have cash flow on it. They're still living tight. One person in particular, they were just always had lived tight, never had money, have all this land, and I think still have it today, but like will never, until they sell that, they're never going to have liquidity or feel like they have any money at all, even though their net worth is really high. And the problem there, obviously, is that if you don't have that money when you need it, you don't feel the full impact of that wealth. And so structuring that, right, so it's all split out, is incredibly important.
Yeah. Well, life is better with friends, especially when your friends are all professionals, high professionals. And these are all professionals that we should probably be using, even if we're not high net worth, but the ultra high net worth people use them for sure. And that's financial advisors, accountants, estate attorneys, insurance professionals, private bankers. Brandon, you want to expand on these, beginning with financial advisors?
Yeah, everyone needs a financial advisor. No conflict of interest. No, but it is. I mean, it's I can't tell you how many times I've come across someone who's like, yeah, I can't afford a financial advisor, so I'm not going to, and they just leave untold money on the table, right? Because they didn't understand certain strategies. And so I think having someone who is trained in financial advising, who they can trust and make sure they're doing the right thing, that's incredibly beneficial. Hopefully people listening to this podcast are aware of that at this point. But accountants too, right? I mean, accountants are so valuable to make sure that we're using the tax code as efficiently as we can. And it's important that your advisor and your accountant talk together, right? That they're on the same page, that they know that one isn't trying to implement one strategy and another. And so you got to make sure those are together. Estate planning attorneys, making sure that right now, it's important to make sure that we're, passing money on as efficiently as possible, which that's what's hard about this is estate laws change. And we, might have a certain allowable amount today, and then that can all change in a couple of years. And so, you need an estate planning attorney, and you need to review your estate plan, especially if you're, in that ultra high net worth, especially, but really everyone needs to review that and make sure that comes together.
Especially if you've had multiple spouses, I've heard.
I guess it depends on how that ends.
we did a podcast where you got to review who the beneficiaries are, because one of your spouses just might get lucky. Ex-spouses. If you don't update properly on those, but yeah.
Insurance professionals, you want to make sure that you're not hit with some crazy lawsuit that derails everything, especially once you start, getting into the high net worth and ultra high net worth categories. People take note, and there are people, unfortunately, that try and go after that. And so it's crazy not to spend a little bit more on, an umbrella type policy or something that kind of catches those bigger risks, so we're not moving one step forward and two steps back.
Yeah.
And then finally, private bankers, using private bankers to help with kind of what I was talking about earlier, right? Help with cash flow management, because we don't want to have to liquidate investments anytime we need money, or unwind, everything we're building on our investment side just because we need to go out and buy, another property that's a good deal or something like that.
Yeah. Rex, what about charitable giving?
I think on charitable giving, that the ultra high net worth and those that are wealthy, again, trying to make their giving very efficient, right? They're still going to have their pet foundations, their pet causes, their pet, things that they're trying to give to and support and encourage, but they're going to find the most tax efficient way to do that. And they're going to, whether they're setting up their own family foundation at that point, which a lot of the ultra high net worth are doing for multiple reasons. One is because you can kind of control and bunch your charitable donations into that family foundation during different time periods when you might be in higher brackets, or you might have more profit that needs to be sheltered, things like that. And so they're going to structure those a little bit tighter and better than maybe somebody that may have $500,000 and we're just looking to give, $5,000 to a charity, to where we can, we may just do that out of our IRA account or retirement account or something to offset taxes again. We're also going to, on the estate planning side, we're going to get into trying to pass on as much of that wealth to and through our legacy to whomever that is that we're trying to benefit, whether it be kids, whether it be family, whether it be a charity. And so that's where we're going to get into a lot of the estate planning for our charitable giving through charitable remainder trusts, through charitable lead trusts. And so, a remainder is that after 20 years, whatever hasn't been spent down in a trust goes to that charity. On a charitable lead trust, it's that, for the next 20 years, a certain amount goes to a charity, and then whatever is left ends up going to the ultimate beneficiary. And then we're going to utilize IRA accounts to do what's called at certain ages to do, qualified charitable donations or QCD donations out of our IRA accounts, so that we're not getting taxed on those as income and then not able to deduct them because we don't have enough write-offs at that point. Now, the ultra high net worth typically doesn't run into that kind of an issue because typically we have enough write-offs to where we're itemizing our taxes. But it is a little bit of a tax game. And it is interesting because you keep seeing Congress and our politicians changing the tax code on the income tax rates, right? And they're like, oh, we're really going to sock it to the wealthy by, changing the tax rate on earned income from 35 to 37 or to 39 or to whatever the tax rate is, when in reality, the ultra high net worth get most of their money and income through capital gains, right? Or through dividends, which are taxed at different tax rates than income. And so, the income tax rates typically hurt the low income and the middle income families more than anything, because that's who has most of their income earned through a W-2 or through a self-employment business, through 1099. So I mean, there's a lot of pieces there. I think there's a lot of things between the professionals and the charitable giving and things like that, where advisors and accountants and estate attorneys can all be working together so that you're not stepping over dollars to save dimes.
Yeah.
And I think that's a mindset that is interesting, because I think as you're trying to become a high net worth person, that your focus is, I've got to save every dollar. I can't pay you to do something that I can and should be able to do on my own. But yet the reality is that you may make more money going and doing it on your own and paying for the professional to do what they do best, because there might be a couple of things that they've learned over the years.
Maybe, yeah.
That you might not be able to read on some internet article.
Right.
So,
and I pull up a lot of internet articles. So, Brandon, go ahead.
I do think, let me add one more thing on the professionals. I do think as you're looking at your professional grouping that's helping you, that, lots of times your financial advisory team kind of acts as, your, to use a sports analogy, right? And sometimes, sports analogies work, sometimes they don't, but in this case, you kind of own the team, right? It's your money, it's your assets, you own the team. As a financial advisor, typically we're the quarterback of the team, right? We're the field general, we're the ones coordinating, what you're trying to achieve, what your goals are, which is to win the game, and the other professionals that are trying to help you, right? And so that's the accountants and the estate attorneys, because typically the advisors are the ones meeting with you on a more regular basis than your other professionals, right? An estate attorney, you may be meeting with every 3 to 5 years or major life changes. An accountant, typically you're meeting with somewhere between 1 to 4 times a year as we're going throughout our tax changes. Insurance professionals, typically once a year. Private bankers, depends on kind of how we're utilizing them, if it's for lending, if it's for cash management. And so, but typically you want that financial advisor to be kind of your quarterback, to be coordinating all of these different pieces with you.
Okay. Brandon, you got some more numbers?
You bet.
To assist this high income, high net worth, well, I guess it doesn't always have to be high income, but high net worth at least. Yeah.
So this is more just interesting. Bank of America tracks spending on credit cards versus debit cards. And they split it up, actually. They go, in households under $125,000 of income and households over $125,000 of income. And, over the last couple of years, there's been kind of an interesting shift. Credit card spending and this is for households under the $125,000 relative. So credit card relative to debit card or all card spending was down in 2022 and it's been down in 2022, 2021, and 2020. So ever since the pandemic hit, credit card spending relative to overall credit and debit card spending has actually come down in the households making less than $125,000. It's also interesting to note that households making more than $125,000, it's actually just slightly up. And so anyway, I thought that was kind of interesting to see those cultural shifts. I know in the news, and you hear a lot, like people are saying, "Oh my gosh, like times are tough, inflation," and I think there's definitely inflationary pressures at work, but I think countering that is people's concern of is there a recession, or are there tougher times ahead? Especially having gone through COVID in 2020, where people are a little bit more prepared, right? And they're being a little bit more cautious financially. And you're still seeing that in the numbers, even as late as, just last year.
Speaking of credit cards, Rex, what's the nicest Amex card you can get?
Oh, I have no idea. Is there a platinum? Is there a blue card?
I don't know.
I have no idea. I don't know. I know they've got like 7 different kinds.
Just want to make sure, you're getting all the airline miles or whatever you need to get. So,
yeah, there's a lot of nice credit cards out there, I'm sure. And so I try not to use them very much, but I do use them on occasions. And if, to leverage for that reason, for points and mileage, but we try not to carry a balance, just like all of you.
maybe that's why you can maintain your high net worth. So speaking of, how do we do that? You've made your money, we are all now ultra high net worth people. How do we keep it? What do we do?
Well, I think, one of the statements that you hear me say frequently is that concentration creates wealth and diversification protects wealth, right? And so in order to get to the ultra high net worth, typically that comes through concentration. Typically you've concentrated your time, money, and efforts in one area, whether it be real estate, business, or the financial markets. But typically it's in one of those three. And so if you're looking to maintain your ultra high net worth, then typically we're starting to diversify if that's what we're trying to do. And so then typically by that point, we may be involved in businesses, we may be involved in real estate, we may be involved in the financial markets, and typically all three. If you remain concentrated and you're in the ultra high net worth category, again, difficult lessons are learned when you remain concentrated. And so we do want to diversify. We do want to spread those assets around. That doesn't mean that you can't take calculated risks with a part of it and utilize some of that to not go fully concentrated, but you might be overweight in certain areas for those opportunities, and that's okay. But if you really want to protect it, you can diversify. And then also you're going to, typically if you're in the ultra high net worth, one thing that we see is that they're not afraid to use leverage. They're not afraid to use debt for certain things. And so you do want to avoid major risks, and you want to transfer risks to insurance companies through insurance, meaning that whether, like Brandon talked about, umbrella insurances, LLC policies, different kinds of insurance to protect you from litigation, from major things that may come about. But then we, on the flip side of insurance, we may want to utilize debt if it's lower interest rates versus the opportunity that presents itself. But we want to be smart about how we do that. We don't want to have to sell out stock at low points or go through a liquidity event during down cycles. And so they're going to utilize their assets in order to maximize the rate of return, and they're more focused on wealth creation and protection at the same time as they go through these processes.
Okay. Good stuff. Well, we covered quite a bit today on how the wealthy invest and what we can learn from them. So $1 million is still wealthy, I guess, if you've got that in net worth. But over 10 million to 30 million, somewhere in that range, is ultra wealthy or ultra high net worth, correct?
Yeah. Yep. We would say that if you're in that 10, 20, 30, 50, 100 million, 150 million, then you definitely should be reaching out to us so that we can work with you on your wealth.
And then there's the Elon Musk, Bezos, whatever level that is, whatever the hell they're at, of level of wealth, which is they own the planet. That's a whole nother. We're not going into that one. How to become wealthy over time? There are some personal habits, but as you mentioned, the concentration might get you from high net to ultra high net, or there's going to be something significant that has to happen in order to go from wealthy to ultra wealthy.
But you got to be careful too, right? Because just because you're concentrated doesn't mean it's going to grow. And I think probably the best story, we had a client come in and had all their money basically in one stock. Mm-hmm. And we did a financial plan, looked amazing, talked about, the risk of it all being in one stock. Like, all right, yeah. I mean, it wouldn't have ballooned out to the number that it had if they had just been diversified in the markets, right? It would have had a good rate of return, but not, the stock just took off. Anyway, we talked about diversifying and said, okay, perfect. Let's get back together. I think they had a vacation or something. Came back 2 months later and the stock had just dropped off. Just dropped off. And the entire plan changed, right? And so, it's important to know that concentration, like Rex always says, number one, creator and destroyer of wealth. And so, what is concentration? That might be ownership in a business, like a business that you run. It might be one stock. It might be ownership in a ton of real estate in one area, and that concentration, if you concentrate, your odds of extreme ups or extreme downs go up dramatically. And so, if you're trying to get into that crazy ultra, the really high, sometimes that concentration needs to be there. But man, it sure feels good to have a little bit of diversity set aside that isn't going to just scream up or down without you.
Yeah, for sure. Thanks, Brandon. What the investments, though, sort of look similar to what normal people can do. However, the more money you make, the more options you have or acquire. That opens up some doors for you that just lower net worth individuals can't do or can't access. Surround yourself with professionals, lots of them, good ones, hopefully. And there's charitable giving considerations also, and maintaining your net worth for, and how to pass it on to your family and stuff. Rex, what do we miss?
No, I think those are all key components, right?
Yeah.
We talked about kind of the three pillars, which is, real estate and businesses and financial markets. And I think that's typically how you get to be the ultra high net worth is kind of focusing on one of those. But I think there's a couple of things. One, risk is risk, right? You can lose it, right? And so, I don't want people to listen to the podcast and say, oh, wow, if I take risk, I'm going to become ultra high net worth. And you may, but you also may go bankrupt, right? And so, make sure that you're aware of the risks. I think if you're really striving to grow your net worth, it's okay to take calculated chances. It's okay to fail. And don't look on failure as a negative thing. Look at it as a learning opportunity. Look at it as what did I learn from this, and how do I change it so I'm different next time on my next opportunity, and be willing to pivot. That if you see things going in one direction and it's not working, then don't be so married to whatever that process or idea is that you shut yourself off from good advice, and that you're unwilling to pivot and to make a change in order to try and turn that situation into something positive. I think that's one of the common traits that I see in the ultra high net worth is they're not afraid to fail. They learn from their failures. They're willing to pivot and change directions. And they're very receptive to professional advice in areas where they may not be quite as strong or quite as competent in, and they recognize that. They're very self-aware typically.
Yeah. Awesome. Thanks, Rex. Thank you, Brandon Smith, both with planwithbaxter.com. For more information, visit planwithbaxter.com. Like our Facebook page, Through the Pines. Follow our Instagram @Pines_podcast. Subscribe to our YouTube channel, Through the Pines Podcast, and you can see our wonderful, beautiful faces. This has been Through the Pines, reminding you to use yesterday's dollars to finance tomorrow's dreams.